Hello everyone. We had the RBI Monetary Policy Committee deliver a status quo on interest rates, that is the repo rate. This was largely in line with our expectations as also market expectations. We did see a 0.5% or 50 basis point cut in the SLR rate or the Statutory Liquidity Ratio. But apart from that, all other key benchmark rates were unchanged. The vote was 5:1 with one member of the MPC voting in favor of a 25 basis rate cut. The RBI also has increased the CPI, that is the Consumer Price Index, or the inflation, retail inflation projections marginally higher in the range of 4.2 to 4.6%. However, alongside, they've also reduced the growth forecast from 7.3% to about 6.7%. So markets obviously had one bit of not so great news and one bit of maybe a little bit positive news. So on balance, the yields reacted a shade negatively. So the 10-year benchmark government security yield, which was trading at about 6.62% pre-policy, closed the day at about 6.7% or about 8 basis higher. The shorter end of the yield curve, which is largely more susceptible to liquidity in the system and maybe lesser extent to rate actions, continued to remain broadly flattish with muted movements during the day. Now, it's very evident that we seem to have gone into a period of a slightly long pause, with RBI being very clear that the incremental inflation data point could probably shape the policy making decisions going forward. It's also acknowledged the fact that recently the inflation numbers have been a tad volatile, which has probably therefore warranted a mild upward revision in the second half of FY 2018. From a market standpoint, we remain constructive that the absolute levels or the carry yields available in India are fairly attractive, which is also reflected in the FPIs, that is foreign portfolio investor flows into the fixed income segment in India. With the recent opening up of the quotas or the limits for the foreigners, we have already seen initial indications of flows, specifically in corporate bonds in India, coming back from the foreigners. What is the outlook and the way forward? As mentioned, we believe that there could be a period of pause, which means it is very difficult to put a number of a rate cut immediately, probably in the December policy. However, the neutral guidance given in the Monetary Policy Committee statement today leads us to believe that the room or the window for rate cuts have not been completely closed. But as I said, that would not be a thing of immediate action. In this kind of a market scenario, what should fixed income investors do? We think that a combination of short-term and corporate bond-based strategies should continue to form part of core allocation in a fixed income portfolio. This, apart from giving you a slightly higher yield at the overall portfolio level, also tries to cushion some bit of interest rate volatility as these funds run relatively shorter duration. Coupled with the fact that liquidity in the banking system remains to be adequate, we do not expect too much of volatilities on the returns front in such kind of strategies. For existing investors in bond and gilt kind of strategies, our view is that they should stay put, as despite the near-term relative underperformance to its short-term counterparts, this category overall has been a relatively better performer over longer periods of time. Fresh allocations into these kind of strategies could be considered as maybe fringe allocations because the yields are at elevated levels. So probably in the range of about 6.7 to 6.75% on the 10-year bond, we could look at some sort of fringe allocations to such strategies. Broadly, to conclude, status quo on rates would mean that we're not expecting abrupt volatilities on the interest rate front, liquidity to continue to flow into the system to keep shorter end of the yields relatively cushioned, and such allocations in these kind of strategies could be considered even from near to medium term or slightly long term investment outlook. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.